Imagine earning over $1.6 million in the stock market in less than 5 years. Sounds like a dream, right? Meet Jim Paul, author of What I Learned Losing $1 Million. He was a stock market sensation who saw overwhelming success. His strategies brought him great fortunes. However, the stock market's unpredictability is its only constant. Even Paul couldn't evade this. In an unforeseen turn of events, he lost everything. His millions were gone, leaving him bankrupt. The market's volatility had crushed his empire. Yet Paul's tale is about loss. It is a goldmine of wisdom and warnings. It provides insight into nature of trading and offers solutions. We'll delve into 7 strategies that may shield you from a similar fate, furnishing you the wherewithal to brave stock market. Stay with us as we dive into the 7 stop-loss methods that could save you from a similar fate. The first stop-loss method is setting a fixed amount. Now you might be asking yourself, what does that mean? What does it entail? Well, it's quite straightforward, really. This method serves as a risk management strategy that is all about determining a predefined amount of money that you're willing to risk on each trade. You must be thinking, how does one go about it? Imagine the concept of defining your comfort zone in terms of finance. It's about setting a financial boundary, a line in the sand that you are not willing to cross under any circumstances. It's a guard against overspending and a protective barrier to safeguard your assets. This set limit could be $100, $1,000, even $10,000. The amount itself is not what determines the effectiveness of this method. The actual value you set can vary depending on your financial standing, your risk-taking ability, and your investment objectives. But what is undeniably important is that once you have established this amount, you stick to it for each trade you venture into, regardless of how tempting it may be to push the boundaries and risk a bit more. So, how does this method protect you from incurring significant losses? The logic is simple yet powerful. By having a set amount, you're effectively placing a ceiling, a cap on your potential losses, a limit that guards you from the spiral of losing more than what you are comfortable parting with. It acts much like a safety net, vigilant and ready to catch you if the economy plunges and things go south. It is a fundamental yet effective method to manage and mitigate your risk. It's not about every trade, but preventing yourself from losing more than you can afford. It gives control over your financial stakes and helps you keep emotions in check. It might seem like a reductive approach, but its simplicity is its strength. It's about discipline, consistency, and most importantly, self-preservation. Remember, the key here is to stick to your set amount, no matter what. The next stop-loss method involves calculating a percentage of your total investment. Picture this. You've invested your hard-earned money into a selection of stocks, each making up a unique slice of your financial pie. This method of limiting losses comes into play by setting a stop-loss level as a percentage of your initial investment. Suppose you've decided to set your stop-loss at 10%. This means if any of your stocks decrease in value by 10% or more from your initial investment, you'll automatically sell them, thereby stopping further loss. It's like having a safety net under your financial tightrope. This strategy is particularly useful for those who have a diversified portfolio. Why? Because it allows you to manage risk across different investments effectively. It's not about putting all your eggs in one basket, but rather understanding that each egg has its own cushion, safeguarding your financial future. This method is especially useful for those who have a diversified portfolio. Now let's talk about the moving average stop-loss method. This method is a dynamic approach that adjusts to the market's rhythm. It's like dancing with the market. You move as it moves. In this method, the stop-loss level is set based on the moving average of a particular market. Imagine a line dancing smoothly across your screen, weaving through the highs and lows of your chosen stock. That's your moving average, a statistical tool that smoothens out price data by creating a constantly updated average price. The moving average stop-loss method involves setting your stop-loss at a certain distance from this moving average. If the market price drops below this line, voila, it triggers your stop-loss. This method requires a bit more work monitoring the moving average and adjusting your stop-loss accordingly. But the payoff, it can be significant. You're not just relying on a static number, but responding to the market's tempo, its movements. You're dancing with the market, and if you get the rhythm right, it can lead to a profitable dance. The fourth stop-loss method involves using technical indicators. This technique requires a level of dedication due to its complexity, but the effort is often justified by the results. Let's dive deeper to understand the process. Technical indicators are based on mathematical formulas that factor in the stock's price and volume. They act as a microscope through which traders perceive the market's fluctuating dynamics. Such indicators offer a captivating way to comprehend the market's constant shifts. Traders have a range of indicators to choose from, each with unique appeal. For example, the Relative Strength Index, or RSI, the Moving Average Convergence Divergence, known as MACD, and the Bollinger Bands, created by John Bollinger, are widely used. These indicators play a crucial role in defining stop-loss levels. To exemplify, a trader may notice a stock's RSI drop below 30, indicating the is oversold. They may then opt to sell their shares to prevent further. However, relying solely on one indicator isn't advisable. A blend of different tools provides a comprehensive analysis, enabling traders to make better informed decisions, ultimately enhancing success chances. Remember though, the technical indicator method may not be everyone's cup of tea. It requires time, patience, and a knack for data analysis. But those who enjoy unraveling market intricacies should not to explore this technique. This method is for those who like to dive deeper into market analysis. The fifth stop-loss method is the time stop. This method is a unique one, as it's not based on the movement of the market, but rather on the movement of time. You see, in the world of trading, time is money, and sometimes a trade just isn't worth waiting for. Here's how it works. You set a specific time limit for a trade. If the trade hasn't reached your desired profit level by the time limit, you stop the trade and move on. It's like setting an expiration date on your investments. This method requires a lot of discipline and patience. It's about not getting emotionally attached to a trade and knowing when to cut your losses. It's about understanding that there will always be another trade, another opportunity around the corner. So remember, in the game of stocks, sometimes the best move is not to play the waiting game. Time stops are all about patience and discipline. The sixth stop-loss method is the Volatility Stop. Now, this strategy is a bit different. It's not for the faint-hearted. Instead of setting a fixed price point, it's all about riding the wild wave of market volatility. Imagine the stock market as an untamed ocean, with prices rising and falling like the ebb and flow of the tide. The Volatility Stop strategy is like setting a buoy that moves with these waves. It's about adjusting to the market's rhythm, setting a stop-loss level that shifts with the market's volatility. This strategy can be particularly useful in highly volatile markets where price swings are substantial. But remember, it's not for everyone. It requires a firm understanding of market trends and a higher tolerance for risk. If you're comfortable with the market's unpredictable nature, the Volatility Stop could be your strategy of choice. This method is for those who are comfortable with a bit more risk. Finally, the seventh stop-loss method is the chart stop. This technique is all about honing your skills in reading and interpreting chart patterns. It's like being a detective, poring over the clues and nuances hidden within the lines and bars of a stock chart. Now, the chart stop method doesn't involve a fixed numerical value, like the previous methods we've discussed. Rather, it's a more dynamic approach, where your stop-loss levels are set based on discernible patterns in the chart. You're essentially trying to anticipate where the stock price might go based on its past behavior. For instance, you might set your stop-loss right below a support level, because if the stock price breaches this level, it could indicate a potential downward trend. Or you might use a trend line to determine your stop. Chart stops require a keen eye for detail and a good understanding of chart patterns. So if you're ready to take your trading skills to the next level, this method is worth exploring. These 7 methods can help protect your investments from significant losses. We've journeyed through the practical wisdom of Jim Paul, exploring stop-loss techniques like fixed amount, percentage of total investment, moving average, technical indicator, time stop, volatility stop, and chart stop. Each method is an arrow in your quiver, a tool in your toolbox, ready to shield you from the stormy unpredictability of the stock market. The overarching sentiment of what I learned losing $1 million is not about just winning or losing. It's about discipline, patience, risk management. It's about understanding that the stock market is not a game of chance, but a field of strategy and calculated decisions. If you found this video helpful, please give it a thumbs up, share it with your friends, and don't forget to subscribe to our channel for more content like this. Remember, the stock market is a battlefield and knowledge is your best weapon.